Hello everyone, welcome back. And it's only been a short stretch since gold was being treated like the one asset nobody could question. But the market has flipped the conversation again. Today is Tuesday, May 5th, New York time. Comment below what day and date you're watching from, because markets are moving so quickly right now that even a few days can completely change the setup. And just before we dive in, if you value the work I do here, support this channel by subscribing and commenting "Our John AG" below. It tells me you want more direct breakdowns like this without the noise. So, jumping in. Another week, another panic headline about gold. One side says the move is over. The other side says gold is about to explode. And right in the middle of that, Ray Dalio is telling investors that gold should not be treated like a small decoration in a portfolio, but as real protection. His idea is not that everybody should run out today and bet the house on gold. That is the first thing people miss. What he is really saying is that in a world where war, debt, currency politics, inflation, and social tension are all rising at the same time, holding somewhere from the mid-single digits to the low teens in gold starts to look less extreme than it did a few years ago. And I think that distinction matters, because there is a huge difference between buying gold because you think tomorrow morning is a moonshot and owning gold because you believe the financial system is getting more fragile. Now, the headline everyone wants to focus on is the Iran war. We are roughly 2 months into this conflict, and the strange part is that gold has not simply gone straight up the way casual investors expected. In fact, gold has pulled back hard from its earlier highs, even as the geopolitical situation has become more dangerous. That seems confusing until you understand the mechanism underneath. War can support gold, yes. But if that same war sends oil sharply higher, pushes inflation expectations back up, strengthens the dollar, and forces the Federal Reserve to stay cautious, then gold can get hit in the short term, even while the long-term thesis gets stronger. That is the part most people skip, because gold is not just reacting to fear. Gold is reacting to real yields, the dollar, liquidity, positioning, and the market's expectation of what central banks will do next. So when crude oil jumps and traders start thinking rate cuts are delayed again, gold can fall, not because the world is safer, but because money is being repriced. And that is exactly why this moment is so important. Based on recently published numbers, inflation is not behaving like a solved problem. Energy has become the pressure point again, gasoline has been driving a large part of the recent inflation shock, and the Fed is openly dealing with a messier outlook than it had earlier in the year. So when people say, why is gold down if the world is unstable? My answer is simple, because the market is fighting two different stories at once. The first story is short-term. Dollar demand comes back, oil pushes inflation higher, rate cut expectations fade, gold gets pressured. The second story is structural. Debt keeps rising. Central banks keep diversifying. Sanctions keep reminding countries that the dollar system is powerful, but also political. And more countries keep looking for ways to settle trade without leaning on the dollar every single time. Those two stories can conflict for weeks or months, but they cannot both remain unresolved forever. And this is where Dalio's gold allocation argument starts to make more sense. He is not looking at a single daily candle. He is looking at the system. The dollar had a very weak run last year, then regained some safe haven demand once the Middle East crisis intensified. That rebound does not cancel de-dollarization. It just shows that in a panic, the dollar still has muscle. Another detail worth watching is positioning. When gold has a sharp rally, weak hands usually crowd into the most obvious trade right near the top. Then a correction comes, those late buyers get scared, and the market quietly transfers metal exposure from impatient money to stronger hands. That washout can look bearish on the surface, but it can also clean up the next advance. Recently, investment demand has been uneven, with Western fund flows cooling at times while physical buying in Asia stayed firm. That mix tells me the gold market is not one simple story. It is a tug of war between paper traders and physical demand, and that tug of war is far from over. But here's the question nobody wants to ask. If the dollar is still the emergency exit, why are central banks still buying gold in size? According to the latest publicly available gold demand figures, central banks remained net buyers in the first quarter, even with prices already elevated. Bar and coin demand was also extremely strong, especially across Asia, while record prices crushed some jewelry demand but did not crush investment demand. That tells me something very specific. The people buying gold here are not all chasing a chart. Some are buying insurance against the chart, and insurance feels expensive until the house starts shaking. Now, does that mean every investor should move straight to the high end of Dalio's range? No. And this is where I want to challenge the easy bullish take. A larger gold allocation can reduce certain risks, but it can also create new ones. Gold does not pay income. Gold can correct violently. And if someone already owns a lot of metals, then pushing even more into the same trade during emotional headlines can be just as dangerous as owning none at all. So the better question is not, should I copy Ray Dalio? The better question is, what risk am I actually trying to hedge? If you were hedging currency debasement, gold makes sense. If you were hedging political uncertainty, gold makes sense. If you were hedging a world where bonds no longer behave like safe assets, gold makes sense. But if you were buying only because somebody said a giant number on television, that is not a strategy. That is emotion wearing a suit. Now let's talk about the Strait of Hormuz, because this is the piece that can change everything quickly. A huge share of the world's seaborne oil and liquefied natural gas touches that narrow waterway. When there is even a partial disruption, the market does not calmly wait for perfect data. It reprices risk first and asks questions later. That means higher crude can hit consumers, airlines, shipping, fertilizer, food, and eventually political approval ratings. It also means a president trying to show strength abroad can run into pressure at home if gasoline stays elevated for too long. So when you hear that Washington wants to come out of this conflict looking like it won, understand the clock behind that statement. The market clock is oil, the political clock is gasoline, and the monetary clock is inflation. If those three clocks start ringing together, the Fed does not get to pretend everything is normal. Recently, Fed officials have sounded less eager to declare victory. They are not necessarily promising hikes, but they are also not giving the market the easy-cut story traders wanted earlier. That matters because gold loves falling real rates, but hates a world where inflation rises and policy stays tight. This is why I'm cautious about people who say oil strength automatically means gold strength. Sometimes it does. But sometimes rising oil is the very thing that keeps gold trapped, because it delays the policy relief gold investors are waiting for. That is the counterintuitive part. And yet, the long-term case is still there. Large banks continue to publish bullish gold forecasts, with some year-end targets in the mid-$5,000 area and others much higher, around the low $6,000 area. Those are not guarantees. They are models built on central bank demand, investor flows, fiscal stress, and reserve diversification. But it tells us that institutional money is not treating gold's pullback like the end of the story, and neither are central banks. Now, the de-dollarization argument also needs to be handled carefully. The dollar is not disappearing tomorrow. Anyone telling you that is selling a fantasy. The dollar is still deeply embedded in trade, debt, banking, commodities, and global reserves. But de-dollarization does not need to be sudden to matter. If a small percentage of global reserves slowly shifts from dollars into gold, that is not a headline shock. That is a drain. Slow, quiet, consistent, and very hard to reverse once trust changes direction. Sanctions accelerate that thinking. Not because every country loves the alternatives, but because every country understands the message. If your reserves can be frozen, then reserves are not purely financial anymore. They are geopolitical. Gold has no customer service desk. Gold has no central administrator. Gold does not ask permission. That is why it comes back into conversations every time the world starts splitting into blocks. And then there is China. The important point is not one meeting or one headline. The important point is that China, along with other major trading nations, wants more room to transact outside the dollar system. That does not make the yuan a clean replacement. It does make gold more useful as neutral collateral. That word, neutral, is everything. Because in a multipolar world, trust becomes expensive. And when trust is expensive, neutral assets gain value. Now layer AI on top of this. People may wonder what AI has to do with gold, but the connection is not direct. It is social. AI can raise productivity, but it can also concentrate profits. It can make top companies stronger while making ordinary workers feel less secure. And when a society already has high debt, political division, expensive housing, and weak confidence, technology shocks can become social shocks. That does not mean AI causes gold to rise tomorrow, but it does mean the world Dalio describes, a world of debt pressure, internal conflict, and institutional distrust, is not just about bombs and oil tankers. It is also about whether people believe the system is still working for them. And when that belief weakens, hard assets start getting a second look. If you're successful, share your success story in the comments so others can stay motivated. Because there are people watching this right now trying to stay disciplined while the headlines are trying to shake them out. Now let's bring this back to portfolio reality. For some investors, a 5% gold position is already meaningful. For others, 10 or 15% may be reasonable if they understand the volatility and already have enough liquidity, income, and diversification elsewhere. But for someone with no emergency cash, no plan, and a habit of buying every spike, even a small gold position can become a problem if it is bought emotionally. So yes, Dalio's warning is important, but the real warning is not buy gold now or miss everything. The real warning is that the old portfolio assumptions are being tested. Bonds are no longer automatic protection if inflation shocks keep returning. Stocks can rally even while the macro picture worsens, because earnings, liquidity, and index concentration can hide weakness underneath. Cash feels safe until the currency loses purchasing power. And commodities can move violently in both directions when war and policy collide. That is why gold keeps showing up in serious allocation conversations. Not because it is magic, because it is one of the few assets that sits outside another party's liability. And in a world where liabilities are the problem, that matters. So when gold falls while the news gets worse, I do not see that as proof the gold thesis is dead. I see it as proof that gold is being pulled between short-term rate pressure and long-term trust pressure. The next major move likely depends on which pressure wins first. If oil cools, inflation fears ease, and the dollar softens, gold can regain momentum quickly. If the conflict escalates, oil stays high, and the Fed remains pinned down, gold may stay choppy longer than bulls want. And if central bank demand keeps absorbing supply underneath the market, the correction may end up looking more like a reset than a reversal. That is the framework I'm watching. Not hype, not fear, structure. So let me know in the comments, are you holding gold as a short-term trade or as long-term protection against a changing system? Because those are two very different decisions. And if you only take one thing from this video, let it be this. Dalio's gold call is not really about predicting tomorrow's price. It is about admitting that the world has become harder to hedge with traditional assets alone. That does not mean gold has to go straight up. It does not mean you ignore risk. It does not mean you buy because someone famous set a percentage. It means you look at war, oil, inflation, debt, the dollar, central banks, and social tension, and you ask whether your portfolio is built for the world we are entering, not the world we wish we still had. If this helped you see the gold story more clearly, subscribe to the channel and keep the conversation going below. And remember, everything I've shared here is for education and market discussion only. I'm not your financial advisor, and I don't know your personal situation, so use this as a starting point for your own thinking, not as an order to buy or sell anything.